please forgive me for any technical glitches that I may have. Can you all see the screen okay?
Yes.
Okay, very good. So we're going to talk about local lending live Q&A. David and Scott are going to give a nice overview and they're going to introduce themselves. And then we've got some questions that some of the participants that are here today have sent prior. But feel free to either unmute your microphone to ask questions or ask questions in the chat box. And Tiffany, if you could keep an eye on the chat box, I'm not seeing it right now.
Got it.
Okay. Ah, sorry. All right, well, there we go.
It's good to get the first one out of the way.
Okay, so as you all know, we have our primary website is sanibelrealestateguide.com. Some of you may know us through our Gulf Coast homeguide.com. And thank you for joining us today. David, could you take a minute to talk about the bank you work with and how you've started the lending program there and a little bit about yourself?
Sure. I joined Sanibel Captiva Community Bank in 2008 and created the mortgage department there. Over the years, we've grown. We have 20 employees in that department now, which is about 20% of the bank's entire staffing. We have 7 loan officers servicing Sanibel and Captiva Islands, of course, but then we have 6 additional loan officers serving Lee and Collier counties. We're going to close 500 loans this year. We have, 13 processors and closers that keep everything moving forward. And I'm proud of this little bank. Nothing to do with residential lending, but we closed 760 PPP loans during this Corona crisis. And that's your neighbors, small businesses, the places you love to shop. We're helping them stay in business. We have $180 million of loans in forbearance. No fees, no derogatory credit reporting, no make it all up at once. We're just letting people take 90 days off, catch their breath, and come back to work on this. And we haven't laid anybody off. Our entire staff has been retained during this, this lockdown, and everybody's getting full salaries. We're doing our part to keep everybody healthy and prosperous. That's what we're doing.
Great, thank you very much. What are some of the things you love most about Southwest Florida and things you like to do here?
Sure, well, my family, we live on the Caloosahatchee River and we're avid boaters. In fact, when this is over, I'm getting on the boat and taking my wife out to dinner. So we spend a lot of time on the water, paddle boards, kayaks, boating. And then we have a dog. We have a little Weimaraner puppy, and that's all you need. You got a boat and a dog, you're done.
Yeah, life is good. Very good, thank you. Scott and I have known each other for several years now. Tell us a little bit about what brought you to mortgage lending and a little bit about your company and about you personally.
Yeah, thanks for having me first off, Susan. I appreciate it. So I've been in the mortgage business now a long time. I got into it when I was about 19 years old. I was selling copy machines, and some guy chased me out of an electrical supply store that was a customer of mine, and I figured I'd stick my toe in the water, and I haven't looked back yet. I just love the business. So I've been with my my current company. Well, I've been there 20 years, but we changed to Primary in September of '09. So I've been with Primary technically for 11 years now, and that's that. My team's comprised of 4 people. I have myself, my production partner Heather, or 4 additional people, I should say. Tori's my relationship manager, Steve's a senior loan officer, and Heather Dowling's my processor. We're a mortgage bank with in-house underwriting, in-house processing. When I am not working, I'm dealing with the chaos in my life, Susan, that you've experienced yourself. I have 3 teenagers. My son is 14. My girls are 17 and almost 19. So when I'm not working, I'm dealing with some sort of teenage level drama, and that takes up an awful lot of my quote unquote free time.
I relate to that way too well. All right, well, thank you, gentlemen. Let's get started with some of the content that we have to offer today. All right, so I know a lot has changed in our world. And what I'd like to do is ask both of you what you feel has changed prior to COVID, now that we're going through the thick of COVID, and what we expect lending to look like after this particular time. I was hoping that maybe, Scott, you could give us a little bit of an overview on the economic situation and how this may be different than it was in years past. We had a great conversation about a week ago about how this situation is different than other recessions we've seen in past.
Yeah, I'd be happy to, Susan. So, you know, when people hear the word recession, they think 2008, and they think real estate values are going to crash and foreclosures are going to spike. And what they don't understand was 2008 was a housing collapse that created a recession. We are now living in a recession that's caused by a medical crisis, and it's a very different thing. If you take 2008 out of it and you look at prior recessions, historically, home values actually go up about 6% during recessionary times. That's fueled mostly by low interest rates, as we're now experiencing. But the one thing that's very different now versus 2008, I mean, there's a lot actually. One of it is, you know, in 2008, most people were getting mortgages they didn't really qualify for. Many people were buying multiple homes. Most people were doing no money down financing. And there was very little equity out there. Fast forward to today, the average person is nationally is sitting on about 25% equity in their home. Everybody's in loans that they qualified for. Most people have one loan or two if they're able to do so. It's not like, you know, the local bartender has 5 or 6 homes, investment properties, which is what happened back then. So it's a very different, the mortgages they're in, they earned, so to speak, and the equity position strong. Furthermore, over 60% of the homes in Southwest Florida are owned free and clear. And if you put all of that equity on top of, you know, if you stack all that equity up, a monumental housing collapse just isn't economically possible. The numbers just don't go there. What I've been saying through this whole thing, and I think will be correct, and, you know, David, I'd love your take on this, but I think we're going to look back on this that housing was the silver lining of the black cloud that we're going through economically. I think housing is going to do very well. In fact, purchase applications numbers were released yesterday, and purchase applications are up 35% from this time last year. So, I mean, just compared to a year ago when things were quote unquote normal, things are up substantially, and I think that's going to continue because of the supply and demand.
Thank you.
And I concur.
David, can you talk a little bit about the lending landscape that you've seen through SanCap's experience throughout Southwest Florida, both
Sure.
prior to this situation we're in now and how the bank sees things going forward?
Yeah, I would do that. And I'm going to start at the end and go backwards. We saw a lot of overlays, they're called, which are, when we sell loans, small bank like ourselves, we're going to sell them to aggregators who are eventually going to roll them into mortgage-backed securities and offer them through Fannie Mae and Freddie Mac. Fannie and Freddie didn't really change their guidelines per se, but the aggregators did. They just kept raising the bar, make it more difficult to qualify, higher credit scores required. A verification of employment. We used to have to verify within 60 days of the note signing. Then we were down to 72 hours. I mean, the joke was we're going to have to go we're going to have to knock on the door and see if the people are still there. It was getting that kind of tight. But those overlays are being lifted now, this week. It's already reverting to normal. So the landscape got pretty constricted because people didn't know what to expect. There was a lot of uncertainty in my life and everyone's life. We have a better idea of what we're going to do going forward. And I'm in agreement entirely. I think residential lending and real estate sales are going to be terrific in South Florida in the 3rd and 4th quarter. This is strictly anecdotal, but if I had just sheltered in Detroit or Chicago or Philadelphia or New York, I don't want to spend another lockdown in New Jersey. If someone had an idea that they wanted to get a place in the sun, they're going to get it now.
Are you seeing an increase in the number of loan applications
Emphatically, yes. Purchase in particular, you might think that this
Yeah.
charge is being led by refinances, and there's plenty of refinance to be sure, but lots of purchase activity, and I don't think it's unique to our bank. I think that we're seeing that all over South Florida. Yes, so the short answer is yes.
Great, thank you. What has been the biggest challenge, David, since you...
Sure, we'll start there. Well, first one is like, there's the obvious thing. Everybody's working from home. Your clients are probably working from home. My entire staff is working from home. Appraisers and title agents are working from home. And that introduces latency, right? My team doesn't have high-speed copiers and scanners in their homes. So they make a pilgrimage to the office once or twice a week where they collect all the documents that have been delivered there, and then they scan them and sort them and send them off to where they go. So before this time, you might send me some documents on Tuesday. We're going to scan them and upload them on Tuesday. Now they arrive on Tuesday and they sit on somebody's desk who then is going to report for duty on Thursday, and we just lost 2 days. So the challenge has just been coordinating all this work from home. And again, it's not just your lender who's working from home. You're probably working from home, and so is everybody else involved in the transaction.
Mm-hmm. Scott, what about you? What have you seen as some of your big challenges right now?
I'll talk at the 10,000-foot level, and this would impact, David, myself, and I would argue every lender in the country. I think one of the biggest, or maybe the biggest challenge facing the mortgage industry right now is this forbearance situation that's going on. The CARES Act basically said forbearance for all, no need to demonstrate a financial hardship. And the challenge with that is, David mentioned earlier that loans are, eventually bundled up and sold on Wall Street. Well, if a loan is going to go into forbearance, the way mortgages work is a mortgage gets split into two things. You have the servicing rights, which is what most consumers would call their mortgage company. It's who they make their payments to. And then the investment vehicle on Wall Street. Well, even if you don't make your payment, the way it typically works is the borrower pays the servicer, the servicer keeps their little portion and forwards the rest to the investor that bought the bond. And what a lot of people don't realize is that even if you don't make your payment to the servicer, they still owe the money to the investor. And this forbearance for all thing disrupted that because the servicing companies are not able to cover. They were talking as much as, I've heard numbers of $1 billion, up to $10 billion they're going to lose during this forbearance thing. And as a result of that, people didn't want to buy servicing rights. Investors didn't want to buy the bonds, and it really caused a 2008-like freeze-up or meltdown of the mortgage industry. Now, a lot of that has been worked through. The government, Mark Calabria with the FHFA, who's in charge of Fannie Mae and Freddie Mac, and then Ginnie Mae, who's in charge of government loans, they've issued some support for that. But when that happened, like David was saying, overnight interest rates or credit scores went up and requirements got tough because nobody wanted to buy the paper. And that is still going on. I think it's going to continue to get worked through, but that's an ongoing challenge for the lending industry, and I think ultimately for consumers. I read a report yesterday that well over half, I forget the number, 60-some-odd% of people that took forbearance have not suffered any financial hardship. And the problem is they're going to have to pay that money back at some time, and I think that might cause hardship for some. So that's kind of 10,000-foot level. At the street level, everything David said is right. It's hard to it's a lot harder for me to run my business with my staff interspersed. Things are just taking a little bit longer than everybody's accustomed to.
And I imagine both of you are dealing with underwriters who also are working from their homes, and that's got to be really strange for those underwriters to be working from home.
So a lot of the industry has already gone to work from home. A lot of underwriters contract, they come in and out of the market depending on loan volume. So it was kind of prepared, but nobody was prepared for this in its entirety. No one ever saw it. So yes, the underwriters are working through it just like we are.
Okay. All right. Interest rate over time. You'll see that in the 1970s, the average interest rate was 8.86. The 1980s, 12.7. 1990s, 8.12. the 2000s, 6.29, and the 10s, 4.07. Today, I never thought we'd be back down at 3.24. When Jim and I bought our house in 2008 here on Sanibel, golly, our rate, I think, was at 7%. It had gone up. It was like a little bubble, and then came down to 5.25. But I like this 2.25. How are you both seeing your interest rates now?
Well, Susan, everything moving fast. Today it's not 3.25. We're locking rates at 3. They've gone down again today. That doesn't mean they'll stay there. They could easily go back up next week in response to some kind of global news, but it's moving fast and the rates are headed lower.
All right.
Yeah, and I would concur. And to add to that, I think we're going to be in this low interest rate environment for some time. I would be very, very surprised if this interest rate environment changes in the next 18 to 24 months. So I think, and like David said, it's funny to me. I got a call from somebody today that, hey, I was quoted an interest rate of 2.875. Can you beat that? And what was interesting to me was that somebody's being offered a sub 3% 30-year fixed rate, and they're shopping around for a better deal. So I didn't even quote the guy. He told me he had worked with the guy for many, many years, and I said, just give him the business. He's doing fine by you. It seems like as low as they are, somebody's reporting them even lower than that. But there is a lot of volatility still. They're bouncing around. And the other thing David said that I think is really interesting, the markets are being moved by headlines now and news reports much more so than economic data and economic principles, which makes it very hard to advise and predict what's going to happen.
So a question that comes to my mind is when we see the interest rates at 3.0 right now, can everyone get that interest rate? What sort of credit scores are you all looking for?
Well, as you can imagine, no. Like any type of advertising or promotion, you always talk about your lowest rate, best offer. But we're assuming credit scores in the mid 700s, 760 or better. We're assuming that 20% down or more, a purchase versus a refinance. But those are real rates. I mean, people really are getting them if they meet those criteria, and many borrowers in South Florida do.
Great.
Yeah, there's something called, and people could Google this. You could Google Fannie Mae loan level price adjustments. I do this with clients a lot, and you could pull up the matrix. Fannie Mae and Freddie Mac conventional loans, they have something, most loans actually, if not all, have risk-based pricing, which basically means the riskier the loan is, the higher the interest rate is going to be. So, I could do a conventional loan down to a 620 credit score, but like David said, you're certainly not getting a 3% rate. What is the occupancy? Is it a first or second home? Is it an investment property? Is it a multifamily? Is it a condo? All of these things come into play and they adjust interest rates. So, some people's scenario, they're still qualifying for rates in the 4s because maybe the score is really low or it's a special program. So it's all over the place. And I think it's important for people thinking about buying to make sure they find out what rates would realistically be for their particular situation.
Mm-hmm. Great, thank you. Take a look at Scott and David's contact information and jot it down. They're great resources. It's very obvious to me in years of working with David and getting to know Scott over the past several years that these guys are the best of the best in Southwest Florida. They know what they're doing. They know how to advise people. So call on them, and they're available to ask questions that we may not cover coming up. I think what I'll do is, if everyone's had a chance to write down contact information here, I'm going to stop sharing the screen so we can do our Q&A session. All right. Okay. So I've got a number of questions that were emailed to me yesterday. And I'm going to take the opportunity to start asking them, what is the process for determining how much I can qualify for? David, do you want to take that one first?
Sure, of course, yeah. It's a math problem. It's algebra. You solve for X. In roundest of numbers, you can have a debt to income ratio of approximately 50%. Half of your gross income can be applied to global debt service, your car payments, your revolving debt, student loans, your motorhome, your boat, and your residences, your real estate, principal and interest, taxes, and insurance, roughly half. So you know what your gross income is. You can use half of that to qualify, and you just start subtracting things that you have to. Well, I got a $300 a month car payment. I have a $200 a month boat payment. My credit cards, I pay them off each month, but on average, I carry a $3,000 balance. We're going to use 5% of that as the payment, so that's $150. And then you're done. And then you have to make a guesstimate at your taxes and insurance, and that's kind of based on the price range you're interested in. And then so now you arrive at a final figure. This is how much I have for incremental debt service. I cheat. I plug it into a financial calculator. I know what kind of payment I want, or I'm allowed. I know that I'm going to do it over 30 years. I know what the rates are today, and they'll solve for how much I can borrow. It's easy to do if you've done it a million times, and I have. Scott probably has. It's not as easy to do if you've never done it, but you call us and you'll find within minutes, it doesn't take a half an hour, within minutes, we're going to drill right down to how much you can afford to borrow.
Anything to add on that?
No, the only thing I would say, and David touched on it, but, you know, I would say, I would add a couple things. So taxes and insurance can really swing from one house to the next. Is it in a flood zone or not, particularly in Sanibel, is, you know, what is if it is in a flood zone, which obviously it is, what is the elevation? Because I know there's some flood insurance concern. Taxes, you know, if you're buying a house from somebody who's lived in it for a lot of years, the taxes could actually increase, sometimes substantially after purchase. So taxes and insurance I have to look into. The other thing I would say is that there's often a difference between real income and what David and I would call qualifying income. I was speaking to a gentleman today. He just picked up a second job where he makes an additional $8,000 a month, but he doesn't have a 2-year history of that. So agencies, Fannie, Freddie, et cetera, will not allow that income to be used. So, you know, definitely contact David or I so we could not only do that math for you, but also break out the difference between your real income and your qualifying income, because there can be quite a spread on the other side of it. If somebody's receiving non-taxable income, it's actually possible to gross it up and increase the figure. There's income that can be derived from asset depletion. It's very often a lot more complicated than the average buyer might think. So definitely speak to a lending professional that could break down the nuances for you.
So what about the difference between a primary residence and a second home? Does it change?
Go ahead, Scott,
how
you do
this
that.
works?
All right, I'll take that, David. Thank you. No, there's not a bump to interest rates. That's a common question I get. There's, you know, going back to those loan level price adjustments, there's not an adjustment for a second home versus a primary. So there's not much of a difference there. The only difference is minimum down payment. If you're buying a primary residence, you could do it with as little as 3 to 5% down. As a second home, agencies require 10% down. The rest of the stuff is pretty much the same. Obviously, we got to factor your primary housing payment into things. The other thing I've run into sometimes is people think, well, I'm renting up north where I live, so this isn't my second home, it's my primary home. And in the mortgage world, primary home is where you sleep at night, whether you own it, rent it, live with a family member, a friend, whatever. So a second home can also be called a vacation home. But outside of that, it is largely the same. David, I don't know if you have any other guidelines or anything to add to that.
No, the distinction between qualifying income and the income you pay taxes on is an important one. Capital gains, that's real income. You got to pay taxes on it, but we can't use it.
Right.
Great. Any questions from the field? I've got plenty more to bring up.
For the 3% interest rate, 20% down payment, and the credit score 760 or above, what's the term of that loan?
30-year amortization, and there's no prepayment penalties, and there's no points associated with it. So I guess that's the answer.
Well, what's the rates on the 10 to 15-year mortgage? How much does it change?
Well, I haven't seen any 10 years recently, and I just don't have that at maybe Steve does. 15-year, we just locked somebody today at 2.75. So we saw rates today we haven't seen in 2020. Today was a unique day. I'm lucky to be talking about this today instead of yesterday, but there you have it. Today's rates are quite good.
Thank you.
As a rule of thumb, I think it's safe to assume a 15-year mortgage is between 1/4% and 0.5% less than a 30. That could change day to day because the bond markets are weird. When you start getting into less common terms like 5, 10, 20 years, etc., sometimes there's not as much appetite for those bonds. A lot of times people will think the shorter the term of the mortgage, the better the interest rate, and that's not always the case. There's situations where a 10-year mortgage might be priced higher than a 15-year mortgage because there's just not as many of those being done. Therefore, there's not as much appetite on Wall Street for those investments.
Yeah, that makes sense. How about for a fully completed application, say from the initial receipt of that through closing, and I know the appraisal process can get a little challenging in these times, but what's the average number of days that each of you are experiencing for your clients?
Our bank, we're seeing 40 days. I mean, I'd like to say 30 because that would be typical and what we'd expect, but it's just not true right now for us. We're seeing 40 days on most of our closings.
Yeah, and I would concur with that. Last year, I averaged 28 days start to finish. It's definitely longer than that now. And the other thing that comes into play with that is there's so many things that are that can influence that. I'm doing a loan for somebody now. We need her 2019 tax returns to be done. Her accountant lives in Michigan. The place is shut down because of the virus, and he's just physically not capable of doing what would normally take him 5 minutes. I've been waiting on for a week, and it's slowing things down. So, there's a lot of things impacted right now that could impact the timeline. But I mean, David, you'd agree, right? If you were an agent right now and you were writing a contract, you put a 45-day closing on there, and you would think nothing of it, right?
Absolutely not. And I think we're not getting much resistance to that. Probably like you do, I work with the same agents over and over, and everyone kind of understands it's 45 days right now.
Okay, thank you.
Yeah, it's a safe bet.
Well, I'm glad you asked that question because that was my next question to ask. How long does it take to get a mortgage and close on the house? So we're hearing 40, 45 days. Here's a question. We're thinking of relocating full-time to Southwest Florida. We'd like to be able to buy a house, then move down, but our agent said we need proof of employment for a loan. Is that always the case?
Well, case, yeah, go ahead.
I'm going to go first, and then I'll tee you up nicely, David, because I think I know, because there might be some unique portfolio options you have for this. So it is a challenge. If somebody's moving down here, they're relocating down here, we do need local employment. There is an exception. There are scenarios where you could use what the agency calls future income. In order to get to utilize that future income, you generally need an employment contract, which is very different than an employment offer. It has to, the definition of the word contract in this context is spelled out pretty clearly. But if you have an employment contract, you're allowed to use that. Sometimes what people will do is maybe 6 months or so before moving down here, they will buy the home as a second home, and then 6 months, a year, whatever down the road. And that way they could use their current income, and then they could relocate down here, and it might be a little bit smoother. But, David, I don't know if you have any portfolio products that might offer up these asset depletion, stuff like that.
Yep, I appreciate you saying that up. I would also add, a lot of people who move down here are retiring. So their income is going to be altogether different anyway. They're not going to come down here and get a new job. They're going to live off their retirement assets, and there's a way to turn that into qualifying income. In our portfolio, and we spoke about this a little bit off camera, we are a commercial bank by charter. So when we do a loan in our portfolio, in other words, I'm not going to sell this to Fannie and Freddie, but I'm going to keep it in-house, we'll underwrite that like a commercial loan. We're not even doing debt to income ratio calculations. We're doing debt service coverage ratio calculations. And so we can consider things like rental income on the subject property, perhaps, or depletion of assets. You have some wealth setting aside in a qualified savings plan, or perhaps just in a checking and savings account. We can turn that into income as well. So we're doing a little more global look, more like a commercial loan, and it gives us some flexibility that we don't enjoy when we go to the agency side.
And one other thing I'd like to add to that is that more and more people, and this trend has been happening for a couple of years, more and more people now work from home. And I would imagine on the backside of this virus, that number grows quite a bit. And, you know, if you're transferring down here with your job or you work remotely, there's no impact at all. All we need is something documenting that there's not going to be a change in your employment status, income, et cetera. And we move forward as if it's somebody working locally. So, again, you got to make sure you talk with, you know, the right people to figure out where you're at. And if you don't fall under agency guidelines, a small community bank like Sanibel Captiva and David is definitely who your next call should be, if you're not on the phone with them already.
So you bring up a good point, and that is, I get lots of prospective buyers that come down and they're looking for an investment condo to purchase. And they're hopeful that if a condo nets $30,000 a year, they can use that $30,000 in the calculations to cover their mortgage. Myth or reality? Is that allowed?
Yes.
Well, I was going to say no, so I'd like to hear your take. Agency
well, there we go. There we go. So this is, you know, this is a great example where not everybody has all the same rules. I mean, the things that David was just explaining, I couldn't touch. In my world, I am able to use 75% of the projected rental income to offset the payments. The projected rental income is determined by the appraiser with market rent. Now, the appraiser is going to use annualized rent. They're not going to use seasonal rent. They're not going to use VRBO type rent, anything like that. And I realize those figures could be much higher, but the agencies just don't allow it. So whatever the appraiser will do, a comparable market analysis of rent, whatever that figure is, 75% of that number I could use towards income. And I'm interested to hear what David's rules are with that.
Well, the agency rules are the agency rules. I haven't explored that apparently in 20 years. I'm not sure why. But in our portfolio, we do recognize it. We consider it a tertiary method of repayment. So first is going to be your income. Second will be your assets. And third will be the rental property. So if a loan's on the bubble, more or less makes sense. We want to do it. We're looking for a reason to do it. Then we'll turn to the rental income on the subject property and include that, and that'll get us over the top.
Okay.
Excuse me, David, on your purchase money mortgages for your portfolio rates, how much higher are they than the secondary market just in general?
Rather. So we've just been bragging about the 30-year fixed at 3%. If I'm in my portfolio, it's 5.375, and it's not a fixed rate. It's a 3-1 arm. And we charge a point. So if you're borrowing $100,000, you have an incremental fee of $1,000. When you hear all that, you say, well, who would do that? But the answer is roughly 50% of my loan volume is portfolio. We have so many oddities about our market in South Florida. There are properties that just don't qualify. There are individuals whose circumstance just don't qualify. And so, but the deal makes sense. You can look at it and know that it should be done somewhere, and we'll put those in our portfolio. And we're lent up. We're at 100% capacity. We can write loans, continue to write loans because we get payoffs every month. And of course, principal reduction each month with regularly scheduled payments. So we're just replacing volume, but there's lots of opportunity for us.
And I'd like to add something to that, to put that interest rate in perspective. Leading up to the Great Recession, America has never, ever, ever in its history seen interest rates sub 6%. So It's interesting. We live in a time now that a disclaimer has to be put behind a rate of 5.375. Historically, that's an amazing rate. I know I bought myself a house in 2003. I locked myself in at 6.5%, and I was literally bragging to people how low of an interest rate that was back then. And it's just, you know, everything the perspective has changed so much. So that interest rate is still a very good interest rate if you look at the historical averages, like you pointed out, Susan, at the beginning of this.
Yeah. A good point comes up when we talk about local lending versus folks coming down and wanting to use their lender back home, or maybe some of the national lenders like Quicken Loan, Rocket Mortgage. I oftentimes hear folks come down, entrepreneurs that have successful businesses from wherever they're coming from, and they will say to me, you know, we have a really excellent relationship with our small bank back home, and because they help us with our business and our personal money, we want to use them. And, you know, I'm happy to have them try that route, but I always like to have them check with a local bank as well, because more than a couple times I have had those sweet, nice banks from elsewhere come up, you know, halfway through the contract to close period saying, oh, wait a minute, we can't do these non-warrantable condos, or, you know, we don't know what this flood insurance means. Can you talk a little bit about the benefits of using a Florida-based lender over a lender that perhaps isn't local?
Well, I think you just did it. I mean, we live here, we work here, but it's more than that. The lender in Minnesota, not picking on Minnesota, the lender in Minnesota, when they go to find an appraiser, who do they call? They have to search online somehow, find some appraisal management company somehow, and hire a stranger. Well, we have a panel of appraisers that have been vetted and approved by our board of directors. The title agent, there's not a title agent in Lee County that hasn't worked with our bank at one time or another. Home inspections, surveyors, insurance providers, we all have, they're in our speed dials. We have relationships that allow this thing to go much smoother. And it's really about the local knowledge. If you're coming from suburb of Detroit, you talk to your banker and you think you know what you're going to get, because up there, nearly 90% of the loans are agency. They're USDA, VA, FHA, Fannie, Freddie. You come down here, and I just said a moment ago, only half of our loans. So you think you got it all figured out, and if you stayed in Detroit, you would have, but you come down here and half the time you're wrong. And you need local knowledge to make that work.
Mm-hmm.
Yeah, and in addition to that, there's, you know, there's things that are unique to Florida. There's aspects of condo lending in Florida that's unique. Even something as simple as estimating taxes and insurance. I mean, just within Southwest Florida, those numbers could vary so greatly, you know, based on a whole bunch of different things. So somebody out of town may throw estimates in there for taxes and insurance and lead somebody to believe that that is within their comfort range and or their qualifying range. And then when they get the real numbers, they're shocked, and sometimes that's happening after they've gone under contract. Mm-hmm. So the relationships are critical, and then in addition to that, the local knowledge. I mean, I'm sure you could call David up, give him a price range and an area of Southwest Florida, and he, as easily as I could spit out accurate numbers and also point out some potential pitfalls for people to look into. And if I was doing a loan in Detroit or Minnesota or anywhere else, I just physically wouldn't have that knowledge. So the contacts and the knowledge together make it very, very important, I think.
Mm-hmm. Thank you. I have a question from one of our viewers. My fiance and I are going to purchase a condo. My income will be used for the mortgage, not his. Can he still be on the title if I'm the one paying the mortgage?
Yes.
Does that work?
Yes.
And does he have any responsibility to fulfill any obligations to that mortgage?
Doesn't have any responsibility to the note. It's not going to be reported against him. If there were any actionable, like a foreclosure in the court, he wouldn't have to defend. But he's on the title. I presume he owns half of it. Maybe he provided the down payment or is providing support for the household behind the scenes while she's using her income and credit to qualify. he will want to protect his interest. Doesn't have any legal responsibility to do that, but there's equity there and he'll want to protect that, I presume.
And what about a married couple? If a married couple is applying for a loan, can you use just one of their income and all that stuff? Or do you have to use both?
Yes, again.
I frequently, if you're in a situation, let's say I look at somebody and one person has a credit score of 640 and the other one has a credit score of 740. If the 740 credit score person has enough income to qualify, it is unequivocally in their best interest to do the loan just in that one's name. Keep both of them on title and all the logistics of that. But to pay a higher interest rate, and some people choose to do it for a multitude of reasons, and that's their right. But it is not uncommon for me to do loans for a married couple in one person's name versus another. Maybe you have somebody with a lot of debt in their name and maybe they don't have any qualifying income, something of that nature. There's a lot of scenarios where that makes sense, and that's not a problem at all.
Okay. David, anything to add?
No, that's
okay. Is it best to lock in rates, and how much does that typically cost?
Rate locks don't cost anything, and it depends on what's happening in the market. Today was a good day to lock. I locked a bunch of loans today. But in the days and weeks leading up to this, was not a good time to lock. We could see that rates were artificially high. I think that was mostly an issue of capacity. I mean, the pipeline was full. So I reduced rates to drive more business when you can't keep up with the business that you have. But the pipeline is clearing a little bit and rates are better now. Short version is I typically advocate for 30-day locks. If I have someone who's especially concerned about the future, maybe they could lock for 60 days, longer rate lock, slightly higher rate in most scenarios. But you can lock for 15 days, 30 days, 45, 60, 90, 120. But most of the time we're trying to lock within 30 days of closing. I presume it's the same, but I guess we'll find out.
So
yeah, and
go ahead.
I'm sorry. I was just gonna follow up to that. I think it's a really important point. And I don't think it's the norm in the industry. I think what most people in the industry do is they just lock everybody at application. And David and I'm perfectly on the same page with David. The right thing to do is to understand the mortgage-backed security bond market, which is actually what controls interest rates. Do an analysis of that. Have that conversation with consumers on the front end. There were periods of time here in the past couple months where I was taking applications at 4% and locking them at 3.25 a couple weeks later because I wrote out that bond market improvement. And like you were saying, David, with the artificially inflated rates. So the right thing to do is to develop an individual locking strategy because, when you lock longer, a lot of people don't realize this. When a loan is locked, nothing actually happens other than the bank is promising the customer this is what the rate will give you at, we'll give you the loan at. But the bank is predicting what the market's going to be at that time. And as volatile as things are right now, the longer the locks are, the more opportunity for volatility. The way you offset that is with a higher interest rate. So to be able to ride that wave a little bit, get within a shorter lock period, nowadays, 99% of the time, it's going to save clients a lot of money, and it's sensible to do versus just locking everybody at application regardless.
Mm-hmm. Thank you. Ken has a question. What is a portfolio loan? What's the definition of that?
Right, that might be our own jargon. I should have explained that. When we originate a loan, we have two paths. Think of it that way. We can sell a loan on the secondary market, Fannie Mae and Freddie Mac. There's a jumbo market that behaves very much like Fannie and Freddie. We call those secondary market loans. Portfolio is our bank lending our money. You make payments to us. We service those loans ourselves. We don't sell those loans. That gives us a lot of underwriting flexibility and probably a little bit more responsive in turn times. But that's the short version. It's a loan that we keep in-house.
Perfect.
Hey, David. Along those lines, for a jumbo mortgage, I think that's typically maybe $600,000 to $650,000. If you were doing that, is there an additional fee to finance a jumbo mortgage?
There's no additional fee. The conforming loan limit, be the same for Scott, is $510,400. So you can borrow up to $510,400. At $401, you're not in the jumbo market. There's no incremental fees, but you will find a delta in the rate. Conforming rates are typically a little bit lower than jumbo rates, and you'd expect that. Conforming rates are underwritten by your federal government, and if they can't borrow money cheaply, who can? And the jumbo market has slightly higher rates. But when I say slightly, we're still in the threes. You can get a jumbo loan at 3.75 or 3.875. And we've seen lower recently. Jumbo rates, interestingly, did not enjoy the rate improvement today that the agency stuff did.
Mm-hmm.
So you're seeing approximately, or would it be fair to say 75 basis points is between the conventional and the jumbo rates?
Yeah, between 75 and 100 basis points. I think that'd be on a typical day, just pulling it out of a hat. I think that'd be about right.
Okay, thank you.
And to add to that, the prior to the pandemic, the spread, at least in my world, and David, probably yours as well, the spread was smaller than that. That spread has increased during this pandemic, so it would not surprise me if that does shrink a little bit more in due time. I don't know if in due time is 2 weeks or 2 years. I don't think it's either of those times, probably in between them, but there is a little bit of a larger spread because when everything started to melt down, like I talked about earlier, the jumbo market was one of the markets that were impacted pretty heavily. A lot of lending institutions stopped offering jumbo loans altogether, and so kind of supply and demand did its thing there. So, maybe in due time that could come down a little bit, but you'll always pay more for a jumbo.
Okay. Give me just a minute here. I own several rental properties and they comprise a large portion of my income. I've heard there's 2 ways to count that income. Can you explain?
Scott, you want that one?
Yeah, I don't know of 2 ways to count the income. If the properties have made it onto a tax return, then we would do an income analysis based off of that. There's a worksheet everybody works off of from Fannie Mae, which is something important. If somebody is building up an investment portfolio or they have one and they want to add to it, showing big losses in all your rental properties, although it may be smart from a taxation standpoint, can definitely hurt you and your ability to really grow that portfolio if you choose to do so as part of your overall retirement strategy and financial strategy. So I think that's something that needs to be people need to be mindful of with their accountants. If it's a newly acquired property that hasn't made it onto a tax return yet, we could take 75% of the lease amount, similar to what the projected income is when you're acquiring it. And David, I don't know if your guidelines are any different than that.
No, that's right.
I have a question about mortgage broker versus a bank lender. I know with a bank lender, they have certain underwriters that they work with. As a mortgage broker, do you work with lots of different underwriter groups? How is a mortgage broker different than a bank lender?
So there's actually 3 buckets in lending world. We have depository bankers like David, mortgage bankers like me, independent mortgage bankers like me, and then mortgage brokers are a 3rd category. Although I'm not a broker, I could speak to it. So yeah, the way a broker works is a broker is going to work with different lenders, different wholesale lenders, different underwriters and everything. Myself as a independent mortgage banker, I have my own underwriter. In fact, I'm hiring one tomorrow because I lost my last one. But I have my underwriter that works with everything, and then based on how the loan is structured, we'll determine, do we keep it? Is it sold? What are the guidelines? So we have some flexibility there. And that really, when you go from depository to mortgage banker to broker, I think it's often a shift of options, like different mortgage programs. But in the past, things have gotten pretty stabilized. Because David, I mean, whereas I might be able to choose different investors, you have the opportunity to keep it on your books and do a portfolio loan. So I wonder if you and I sat down, if it really would be that much of a spread in program availability.
Probably not until you got to the portfolio. And I think the biggest difference doesn't even matter to the consumer. It's how is that deal funded? A broker is going to go to the table with whoever he's selling the loan to with their money. They're going to fund the transaction. We fund our own transactions, and then we're going to sell them to our aggregators, typically within a week or two. But it's a subtle difference that the consumer probably doesn't care about. He doesn't care whose money showed up at the closing table.
I'd agree with that.
Hey, David, when you're selling to an aggregator, from the borrower perspective, is there any additional cost than selling directly to Fannie Mae?
No, really there's not. We could sell directly to Fannie Mae, but the reps and warranties it's just too much for a bank our size to take on. We would make an extra 1/4 to 3/8% in margin profit, and it's not worth the staffing it would require to make that extra 1/4%. So we send them to larger institutions. They have an army of underwriters on staff, and we let them make that 1/4 or that 3/8.
Great. Well, any other questions from anyone here? David and Scott, this has been hugely beneficial. I appreciate your fountain of knowledge all the time, and so appreciative that you were able to give your time today to so many people.
Well, thanks for putting it together.
Very much.
Thanks
Yes,
for having
thank
us,
you very
Susan,
much.
and thanks, everybody.
I am going to go back and share my screen with your contact information once again, and I'll keep it up for the next few minutes, but people feel free to check out when you need to. And as always, come back to sanibelrealestateguide.com with any questions, and if you need their contact information and you lose your piece of paper, just give me a call.
Thank you. Bye now.
All right. Bye-bye.
Bye-bye. Susan,
Yes.
do you want me to stay on to see if anybody has any trailing questions?
You're welcome to. Absolutely.
Yeah, I'm happy to. So it's D Wright.